Hi, welcome to the video, and today I'm going to show and teach you how I won 100% of my trades on Lemonade. This is live from my TD Ameritrade. I want to be as transparent as possible. You can see every single trade I've made. Right here in this column is the profit column, and as long as there's no negative, it's positive. And there's plenty of other trades I could show you. I don't have a 100% win rate in everything, but Lemonade I thought would be the perfect example to show you how I catch the fluctuations and how I sell and buy back. The reason I want to teach you this is because, number one, all of my friends constantly ask me, so I'm repeating myself all the time now. And number two, I want to give retail traders like me and you the tools to make money. And the day trading stuff, what's being pushed right now, I think is mostly bullshit, not because you can't be successful, but because it's very, very hard to be successful. And this strategy, I think, is more profitable for the patient trader who doesn't have the time to dedicate their life to tracking every single minute movement of the market. But with that being said, let's dive right in. I've put all of my Lemonade trades onto an Excel spreadsheet where we can see it more clearly. So what is my strategy? It's just selling puts. Now, what is a put? Great question. If you already know the basics of what a put is, you can skip this part, and I will put a timestamp below if you want to skip right towards the tutorial. But first, let me explain what a put is. When somebody buys a put, they are buying the right to sell their stock at a certain price called a strike price. So let's say I am a owner of Lemonade stock, right? So I own Lemonade stock, and let's say I bought it at right here $180. Now I'm afraid that Lemonade is going to drop, so I buy a put, aka I buy insurance, and let's say my strike price is $170. So if Lemonade were to drop below $170, because I bought this put, it doesn't matter if Lemonade dropped to $20. I could still sell my 100 Lemonade shares at $170 per stock. Does that make sense? So buying a put gives me insurance. It costs money, but I can lock in a certain rate I can sell it at. Let that sink in. If you still don't know what a put is, look it up and then come back to this video. Now, let's go on the other side of that trade. On the other side of the trade, there's people like me who are selling a put. When I sell a put, I am giving away my right. Basically, I become the insurance agency that collects a premium, cash, because a buyer, the put buyer, is worried that their investment is going to drop. Now, in most cases, if I select the right price point, that insurance they paid me, that contract they bought, is going to expire worthless. And as long as the contract expires worthless, I get to keep that money. This is essentially what theta ganging or put selling is. Now, theta is one of the Roman numerals. It's the amount of money a contract decays every day. Every day that a stock does not move or goes higher or doesn't move fast enough, I essentially get money. Because remember, there is an expiration date, and all I want is for this contract to expire completely worthless. But one thing people don't realize is you don't actually have to wait till expiration date. Remember, the value of the contract is decreasing day by day if you've done it correctly. So at any point in time, if the value of your contract today is worth less than the value of the contract yesterday, what that means is you could essentially buy back your contract to close yourself out of the deal and take the difference as profit. I will elaborate more on this later, but back to the basics of the strategy. On my strategy, I am only selling puts when I think a stock has hit a low. So let's go back to my Excel spreadsheet and we'll look at what happened and how I was able to essentially win, not essentially, actually win every single trade. And I'll walk you through this. Even if this doesn't make sense, it's going to take some time to sink in. So on January 6th, actually, you know what? I'm going to order this by date. So what I did on January 6th was I sold a put. So let's go to January 6th on the chart. Why did I sell a put on January 6th? So here, even though it was roughly a green day, you could see January 6th, the price of Lemonade was about $151. I was very bullish on Lemonade, meaning I thought it would continue to go up. So if I'm selling a put, remember, as long as by the expiration date, the value of Lemonade stock is above my strike price, the premium I collected from the put buyer, I get to keep 100% of it. So I sold a put right about here, right? And it continued to go up. Now, as the stock is going up away from my strike price, the value of that contract is actually going to decrease. And when you are a option seller, you want the value of your contract to decrease, because that means you could essentially buy yourself out of the contract for cheaper. So if I sold a put contract for $1,000, and let's say by January 12th, the value of that contract is only $500, I could buy myself out of that contract, and essentially I would have netted $500 in profit. And that is my strategy in a nutshell. I sold it January 6th for a total proceed of $824. And this is money I see in my account instantly. And it might feel like this is our money when we sell it, but this is not our money yet. This is not a realized gain, because this cash that you see in your account is beholden to the contract that you are still on the hook for until you buy to close yourself out of the contract or it completely expires. And just 2 days later, I bought it back. This is the cost that I bought it back for $290. How was I able to do that? Because again, let's go back to the chart. January 6th, if you look at all the way January 8th, the price of Lemonade went up $30. I got very, very lucky here. But because of that incredible swing and movement, the price of this contract that was originally $824 was now worth a lot less, because the chances of Lemonade hitting my strike price of $105 was very, very unlikely. So the less likely it is that your strike price is going to be hit, the less valuable this contract is, because this is insurance. This is insurance of what happens if Lemonade were to drop below 105. If Lemonade is at $180, the chances of it dropping to 105 are a lot less than it was when Lemonade was at 150. So what I did was I bought this contract to close, and I was able to make a profit of $533. And this is the difference between what I sold it for and what I bought it back for. So remember, you always sell to open and you buy to close. Now, when I sold it, you can see that the expiration date for this contract was just about a month out, 30 days out. And this is a common issue I see, common thing people do, which I think is incorrect. People always want to wait till expiration date so they can collect the full premium. So if I were to have waited till February 5th for my contract to completely expire, then I would get to keep the full amount of proceed. Now, why didn't I do that? Why did I pay money to get out of my contract? Listen here, this is absolutely key. In 2 days, I was able to make 65% of my total profit. I could have waited another 28 days to make $290. But there's no guarantee in the next 28 days that Lemonade wouldn't tank. Here, 2 days later, January 8th, I had a guaranteed profit of $533. And this is another important thing. When you're selling a put, generally you need something called collateral. I had $10,500 of collateral that was tied up in this play, meaning that if Lemonade were to drop, to zero or whatever, I would still need to buy it for $10,500. So most brokerages are going to require to have that collateral. So by closing out this position in just 2 days, I get $10,500 back to put into a new position. And I can make more money more often this way, as opposed to waiting till expiration, where number one, my risk is high that I'm not going to be able to take profit because anything could happen. And number two, it's just not worth it. It wouldn't make sense to wait 28 more days just to get 35% more profit. This is another key thing. Everything I traded in Lemonade this past month and a half, essentially max just required $15,000 in collateral, because the highest put I sold was $148 per stock times 100. So I would need $14,800 to buy this stock in case the stock drops below 148. But with this $14,800, ultimately, if you add up all my gains, I was able to make $5,255. Again, I want to say I got very, very lucky, but lucky, that's the part you can't control. What you can control is just some basic technical analysis. So let's go over a couple of other plays. So I opened another one February 2nd. Let's see what February 2nd looked like. So you see here, February 2nd, it's at a low. You'll never catch the exact low. It's really hard to catch, but I saw that it had been trending down for a while. So I opened one at February 2nd, and let's see when I was able to close it. I closed it at February 3rd. That's pretty insane. What happened February 3rd? So February 2nd, I probably caught it at a low of, let's say, about maybe 145. And then February 3rd, I bought it back at this high at maybe 150. So this is the power of taking profit early. I got definitely a little bit more aggressive. Usually I sell a month to 45 days out, but you can see that it moved so much. I'm not going to wait till expiration because there's no guarantee Lemonade is going to stay at its current stock price. Take profit when you can. And even just that 1 day of movement, I was able to get $218. So I sold it for $304. I bought it back for $85, 72% profit. Let's do one of the meatier ones. So this one, I sold January 19th with an expiration date of February 26th. So about 37 days out. Let's go to January 19th. So January 19th, you can see January 19th, I caught it pretty close to its low. And I'm not a genius of any sort. This is pretty simple to see. It seemed to hit some support here. So this is when I sold it. You always want to sell it at the reddest day, at the lowest possible point you can, because the lower point you sell it at, the lower strike price you can go. And the lower strike price you can go, the less risk you have, because ultimately it's going to have a harder time hitting the very low strike prices. And then if you're forced to buy, at least I'd be forced to buy Lemonade very cheaply, which is okay. I'm generally bullish on Lemonade. So I sold about January 19th. Now, when was I able to close? I was able to close January 25th. What happened January 25th? And you can look at that. It hit a high. Take profit at 50%. You can see here how closely I follow this rule. A couple of times I got greedy where Lemonade swung a lot, but always 50%, 53%, 54%, 51%, 54%, 56%, 54%. $15,000 to make $5,000 might not seem like a lot to some of you, but if it doesn't seem like a lot, you're delusional. This is incredible returns. It's something I probably won't be able to replicate again. If we go back to my TD Ameritrade, as you can see, I've won a lot of them. It's 90%. It's crazy. It's a bull market. This strategy works really well in a bull market. Once it's a bear market, I'm going to have some difficulties. I'm going to need to adjust, but even a neutral market has been quite profitable. It's about getting into the positions at the optimal times that you can. Sell at the bottoms, buy back at the top at 50%. Don't get greedy. Be patient. Try to enter and open these positions at optimal times. Don't just trade because your finger is itchy. That's the worst idea. I'm guilty of it, and it's always come back to bite me in the butt. But let me know what you think of this strategy, or if you try it. I'm not a financial advisor. This is just what I do and what works for me. You have to find your own exact method based on your personal risk tolerance and what works for you. If you have any questions, let me know in the comment section below. I'll try my best to answer them. This is Green Knight Trading, where Squires become Knights. Thank you all so much for watching. I appreciate you, and I'll see you soon.